Hi everyone. Today's video is going to be basics. I'm going to go over what is an option, how do I use options, and then I'm going to go over all the other opportunities for options that I don't really mess with. So let's begin. The simplest way and thing to start with is an option is 100 shares of a company. Well, what is a share of a company? A company has shares. It is a percentage that you can own. It's usually a percent way smaller than 1%. So you can buy a lot of shares. 100 shares is equal to a block. An option is one block of shares. That is an option. When we're discussing options, I think it's important to know what is the risk in options. Almost all options end up being worthless. A hypothetical example. You're looking at a company, it's worth $10 a share. The CEO comes out and says, we're going to grow 10% a year for the next 2 years. And he says the stock option is going to be next year $11 a share, and the year after that it's going to be $12.10 because I'm the CEO and apparently I control the price of the stock like that. If you were to buy an option that expired in 2 years, we're gonna say a call option. You bought it today for $12. In 2 years from now, in 2 years that option would probably end up being worthless, or maybe worth 10 cents or $10, because anytime somebody is discussing an option, every dollar is multiplied by 100, because that's how you determine what an option contract is. When you say this option is worth $1, it's $1 times 100 because there's 100 shares. You're always discussing the share value, not the contract value. So when I'm speaking, I might switch off from saying a $4 contract and it's only gonna cost $400. So that's how I mean. We're talking about Nordstrom yesterday. By the way, I ended up buying 2 of those contracts yesterday. One was for $4.10, and the other one was for $3.90. So I pretty much averaged that down to $4 exactly. The $3.90, I wasn't expecting to get it, but I got it right at the end of market close. I guess somebody gave up and they just wanted to get out, and so they gave it to me. So how do I do options? I do options when I see that the option is a better value than the stock. Let's go back to that company that's $10 a share. The CEO says we're going to grow 20% a year. So in 1 year, the share price will be $12. The year after that, it's going to be $14.40. If I look out 2 years and that option is being purchased and sold, traded for $2, well, that's probably going to give me an advantage of $2. That's going to be awesome. But unfortunately, that's not how the options market works. If you know that information, everybody buying and selling options knows that information. If you can trust the CEO, everybody buying and selling these options can trust the CEO. If a CEO of a company ever said that, then the options would immediately be adjusted for that price. So how do you end up making money with options then, if most of the time they're going to end up going down and being worth nothing? I have quite a few options that has literally happened. I find companies where I would like to own 100 shares. Let's say Nordstrom, just for kicks. I want to own 100 shares. I can't afford to buy 100 shares. I can afford to buy 40 shares at the current price. Or I can buy the option. Let's say the current price is 12 bucks. Wink. Let's say the option at 12 bucks is too expensive for me, but I can buy the $15 option. If I expect that stock to be $30 in, let's say, 2 years, then that contract should help me pay off quite a bit. If for whatever reason that stock, let's call it Nordstrom, doesn't hit the $30 price after 2 years, every dollar that my contract is valued under the current price of the stock, that's going to be intrinsic value in the contract. So let's put it into concrete details. I bought the $15 call. The day that contract expires, 2 years from now, this is how you determine intrinsic value. If Nordstrom stock is worth $20 a share, I bought a $15 call, then my intrinsic value is $5. When you go to sell your contract on that very last day, nobody's going to give you 100% of what you deserve to get on that contract. They want to make a profit. They'll give you maybe $4.90, $490. So yeah, you can make money, but I don't think that's a good way of going about it, because you spent $400 on that contract and you only made $100 in 2 years. Actually, that's just 20%. That's not bad, but that's not why you get into a contract. You get into a contract so you can explode your growth, not have it grow with the stock size. If you bought that stock at $40 at $12 a share and it appreciated up to $20, you would have gotten a better return. So that always needs to be weighed out. Also, with options, you don't get any dividends. That they don't pay out dividends. You don't own the stock. You don't get to share. You don't get to vote. You don't get to do a lot of interesting things that you might be able to do that if you have the shares. Some other information about options. One other way I do options is if you own 100 shares of a company, you can sell contracts. You can sell a contract even if you don't own the shares, but I don't do that. That's beyond dangerous. That's one of those situations where we call unlimited risk. Let's talk about another company for this one. We're going to talk about MFA. We can also talk about IVR or NRZ. These are all mortgage REITs. Let's say we have MFA. Historically, it's been buying and selling the stock between $5, $6, $7 range. I can sell a contract for, let's say, $100. That says I will sell my shares to you for $9 a share. Now somebody has to be willing to believe that that stock will go beyond $9 a share and has to be willing to pay you $100 for that opportunity and to wait for that 1 year to see what happens. You get that $100 right away. So your risk is if the stock goes above $109 and you had sold a contract that said it would be you would sell it for $9, then they might try to cash out that option. But they did pay you $100, so you don't necessarily lose all of your money, but still it's not fun if you have to give up your 100 shares in the company. After all, you own it because you like it. So you should only do that in a situation where, let's say you have a company where it doesn't go up too much, it doesn't go down too much, it's a fairly stable stock. MFA was, recently it's had some bad situations. I do own some of that. That's one of the positions I'm down on. I own IVR as well, I'm down on that. I own NRZ as well, I'm down on that. Jeremy isn't in these, don't worry about it. So why don't I sell options for these stocks right now? Because I actually think that these stocks have an ability to bounce back. And if you don't know if these contracts and these stocks are going to bounce back, then you're not going to be in a position to sell. If you sell, you're placing yourself in a poor position, because now that contract exists. You have to buy a contract from somebody else to neutralize the contract that you sold so that you can break even. That's just a little bit too much complexity. I don't want to get into that. That's gonna go. We don't need to worry about that. You can buy contract spreads. I don't do any of that. We don't need to get into that. That's saying I own Nordstrom stock and the stock is $12. I think it'll go up to 15, but it won't go down below 20, or it won't go above 20. So there's a way for you to lock in and say, if this is the situation that happens, I will have a maximum reward. But when you do that, you usually limit your upside too. I don't like to limit the upside. I like to keep it. You can, of course, short options as well. You can say, in the future, this stock will be worth less, and I want to be able to purchase the stock at the current price, and then have this contract executed in the future when it's at this certain lower price. So let's talk about Nordstrom again. It's a $12 stock. You say, I think it's going to be a $6 stock. I want to be able to basically borrow your shares at $12, and I'll sell them back to you for $6. Generally, that's not a good idea, because that's going to put you in a situation where if the stock doesn't go down, that contract becomes worthless. And in most situations, in almost all situations, the CEO is going to do whatever they can to make sure that their stock isn't going down like that. That's not a fun situation. So you're fighting the CEO, you're fighting a whole lot of other people to try to keep that stock from going up. And it's not a war that's easily won. It's not usually worth your time to get into that type of situation. So this was the basics of contracts. Lots of different strategies, lots of different time frames. One more thing I should probably go into contracts with. It's not on there, as I guess we can call it bonus. It's in the basics though again. A contract for options has 3 parts to it. One is intrinsic value. The second part is volatility value. And the third part is time value. If my contract is going to expire in 2 years, my time value is stable. It's going to remain the same for a long time. If my contract is going to expire in 30 days, the time value is very volatile. You're not going to be able to every day you hold on to a contract that's less than 30 days, less than 90 days, less than 6 months, that time is decaying. Your contract is being worth less and less and less every single day. Volatility, you usually get low volatility if the stock is low, or the stock has very little interest. It's not moving around. Let's say Tesla, let's say Nvidia, let's say Amazon. These contracts are expensive because you don't know how much they're going to go up and down. Because you don't know, the person who's selling it to you wants more of a premium. The closer you are to the deadline, the less that's worth, because there's a less chance of that happening. Let's go with NAT. I followed Jeremy into that one as well. So I have some NAT contracts. I'm very down on those. I'm perfectly okay with that. That's fantastic. I don't care if they end up worthless. It was an extremely small position. So I said NAT will be worth $9. And let's say this contract is going to expire in November. Well, there isn't that much time left in November if today is September 30th. The volatility in the stock isn't that much. The chance of this stock tripling to $9, very low. So I can't sell this contract to somebody with volatility being high. I can't sell somebody this contract with a time value being high. The only thing I can sell this contract to somebody with is intrinsic value. This contract is going to expire in a month, and it's going to give somebody the opportunity to buy NAT at $9. NAT is nowhere near $9. Why would you pay $9 for NAT if you can buy it for, I don't know, less than $4 today? So essentially this contract is already worthless. You want to be in a contract where you have stable time volatility, and you have stable... My brain's farting. And you have stable volatility. Time. You have stable time and stable volatility. The intrinsic value is always what you're working, and is always what you want to get as a bonus. So I'm going to make another video that goes into how to time these, how to value these, how to determine what's a good cause. Actually, I'm going to probably stop this video and record the next one right now. I just don't want it to get too long. It's getting a little bit long. Stay tuned. Part 2 coming up right away. See you guys.